Morning, good afternoon, good evening, and welcome to this TEDx-CarbonTracker event, which is hosted as a part of this kind of series that was just presented to us by TED. We will be talking today about a peak fossil fuel demand. When is the peak and what does it mean for national markets and the geopolitics? So we're going to touch on the two topics from the countdown themes, resilient economies and future of energy. Energy and climate discussions are inseparable. As we just heard, there are many energy sectors that are absolutely critical to be tackled in order to deal with the climate crisis. 2/3 of emissions come from the energy sector, specifically power and end use, and we have a massive job ahead of us to deal with this. IRENA estimates that over 90% of energy emissions can be reduced through aggressive deployment of renewables and efficiency and flexible infrastructure. And all of these things are coming from different sides. We understand that a lot can be changed. But energy is not that visible to everybody. There are roughly 3 types of people when it comes to energy. The people who do not think about it until they get the electricity bill. There are those who do not have access to it, an unacceptable number of 600 million without access and 3 billion with inadequate access, and those who are deeply immersed in all things energy. So the 4 of us in this event today are a part of the last group. My name is Elizabeth Press, and I'm Director of Planning and Program Support at the International Renewable Energy Agency, IRENA. We have 3 terrific speakers with us who will speak on the peak fossil fuel from different angles: forecasts, markets, and geopolitics. We have a Professor Bent Erik Bakken, who is the Chief Analyst of the DNV GL's Energy Transition Outlook. With almost 40 years of experience, mainly in energy and security research, his award-winning work concentrates on behavioral simulation modeling of complex systems. He holds PhD from MIT in policy science. Then we have Kingsming Bond of CarbonTracker. He's an energy strategist and argues that the energy transition is the most important driver of financial markets and geopolitics in the modern era. He has been a financial market analyst and strategist for 25 years. And he also plays the trumpet. And then we have Thijs van der Graaf, who is an associate professor of international politics of Ghent University. We worked very closely with Thijs because he was a lead drafter of the IRENA report on the geopolitics of the energy transformation. He's also the author of Global Energy Politics, which was published this year by Polity Press. So before we start going into content, I just want to give you a couple of technology organizational points. You can actually submit questions. You can put it in a dedicated Q&A box, and we will try to take some of this question in the second part of the session. This webinar is being recorded so that you know, and the recording will be uploaded to the TED.com for distribution in their channels. So without further ado, can one safely assume that what you are presenting is not a mainstream view? What is the consensus in each of your areas and how do you differ from it? Can you just take it in turns so that we don't waste time calling on each one of you? Bent Erik, can you start?
Yes, I think that's a fair comment, that the consensus is that increasingly there is consensus that peak fossil fuels will happen, which was not the case 4 years ago when we started on providing the world with energy transition outlooks. The consensus now appears that oil will peak within the next 20 years, perhaps within the next 10 years. And I think the reason why there is consensus that peak will happen later than what the DNV sees has to do with the fact that a lot of the people who provide forecasts or scenarios, they are not neutral. IEA was designed in 1974 to assure OECD energy security. And we find that the big oil companies, until very recently, have had an interest in, providing a rosy picture to their shareholders. And now, of course, they see that that is not happening. And I think both BP, as was mentioned, and Equinor are examples of this. They understand that the world is shifting, and so they have totally changed their tactics over the last couple of years. And that's why they will move their outlooks to a peak that is even closer, I think, next year than what we've seen this
year. I think financial markets have been a little bit ahead of the energy forecasting community, which is why you've seen share prices derating for a while, because financial markets recognize there's a degree of bias in incumbent forecasting of an eternal rosy future, a bit like buying a second-hand car. The person selling it to you is bound to say that it's great. And that's what it's like taking an oil forecast from the oil sector. Anyway, so we did have a derating before COVID. There's been a big derating since. I would suggest that financial markets are starting to price this type of scenario in. However, there's a large constituency which amongst investors, which basically says, well, this is just temporary, and demand's going to bounce back, and the lack of investment that we're currently making means that prices are going to spike in 2 or 3 years' time, and it's going to be the same as it always has been for the last 5 or 6 cycles. The reason, incidentally, why that's wrong, and to answer your question, Elizabeth, about why we disagree with that type of consensus, is because it's silo thinking. They're just thinking that nothing has changed, that there's no competition. But actually, for the first time, you now have competition right across the energy system from new energy technologies with falling prices, and therefore this kind of sort of silo thinking, which was most famously and idiotically expressed in the gas sector, with people saying, well, gas demand's definitely rising, therefore we can make money. Actually, no, gas demand probably will rise for a while, but gas prices will certainly not be at the levels they were before, because they've got to compete with renewables. Anyway, I won't talk for too long, but it's that's I think why we differ, because we're trying to think more holistically and not just in silos.
So before I hand to Tess, I just want to ask you, because there is a Q&A session and there's people are asking quite a lot of questions, so I would like to incorporate some of them. So there was a specific question to you, Kingsville. Is it counterintuitive? Does the high capital cost for fossil fuel companies means actually greater investment for greater gains for them as well? So is that counterintuitive a little bit that you mentioned in your presentation? The flip side of high cost of capital, is it a high return for investors?
Oh, I see. So no, I mean, if you have the cost of capital is the inverse of the share price, basically. So if the market is giving you a high cost of capital, it means you have a relatively low share price, and you find it hard to raise new capital and allocate new capital. It says nothing about the future returns that you will get.
Thank you. Face over to you.
Well, thank you. And on the question of what is the consensus view in your field, and how does your view differ from that? I think that the consensus view in OPEC and other large producers like Russia still is that they will not be affected by peak oil demand, either because they think oil demand is not going to peak. If you look at OPEC's latest world oil outlook, which I think was published last week, they see oil demand climbing up to a level of 109 million barrels per day in 2045. So that's a massive growth in oil demand that they see, and they are actually an outlier, I would say, among all of the institutions that provide scenarios or projections. So that could be one reason why they think they will not be affected. The other reason could be that they think that they are low-cost producers and that they will actually gain market share over the long term, which I think is a valid proposition. But the key question here, of course, is what good is a rising market share in an ultimately shrinking market and sunset industry? If you look at BP scenarios, you see that OPEC's market share is indeed going up, but their revenues are not going to go up because the market as a whole will shrink. So that still poses them for, I think, fundamental challenges.
Thank you very much. Before we move on, I just want to go back to Bent Erik. There were quite a few questions around nuclear energy because none of you mentioned it. Can you just quickly give us a reflection of how nuclear energy fits in your forecast?
Yes, so nuclear energy is important in parts of the world. at least in OECD, we see challenges for nuclear. Of course, it has the advantage of being zero carbon, but it has the disadvantage of being very expensive. In particular, when you want to address the safety concerns, as is the case, for instance, in the US, you find that when there are close downs of nuclear power plants, you know, they are typically not being rebuilt because of the extremely high costs. And you also see increasingly that, you know, the new permissions to operate, they are becoming very hard to get because of safety. And you see the new plants planned in UK, for instance, their costs are extremely high, and they're only constructed, or if they will be completed, is because that governmental regulations affords higher, that guarantees higher than market prices for their power output. So that's why we see, you know, current plants continue to operate to some extent, but there are limitations on new plants because they cannot compete with renewables on costs.
Thank you very much. So, Kingsman, can I go back to you? You had quite a progressive view on the market, and you know, do you see that people are coming along with you? And I'm going to incorporate another question from the audience. Somebody was asking, you know, why do we still see countries allowing new oil production? How does it make sense, both in terms of what you're talking about, but also in terms of net zero strategies for 2050 and the climate imperatives?
So thank you, Elizabeth. So to answer the first question first, I think consensus is shifting, as I said, led by DNV-GL. So if you think about the timeline to this, 9th September, DNV-GL puts out their piece talking about peak fossil fuels 2019. Within a week, BP has said, actually, we think peak oil in 2019. The International Energy Agency, which, as Ben Derek said, is not noted for its skepticism about the oil and gas sector. They, in their energy outlook, they have 4 scenarios. In 3 out of those 4 scenarios, actually 2019 was also peak fossil fuel demand, and only 1 of the 4 scenarios is fossil fuel going to carry on rising. And they finally now accepted we have seen peak coal demand, and we're highly likely to have seen peak emissions from the energy sector specifically. And I think that, therefore, the point is that consensus is actually shifting very fast. And the big message that we would have at CarbonTracker to the energy forecasting community is you can't hide behind business as usual anymore. If you're still forecasting business as usual, you are either a tool of the fossil fuel sector or you're not up to the job. So it's time to get with the program. And then to answer the second question, why are people still building new oil facilities? Look, there's an enormous amount of inertia in the system. You know, go to most finance ministers, and if you discover a new oil field, a new gas patch, they're like, "Oh, fantastic! You know, this is going to make us all rich." The message is, you know, if you discover a new oil field like Saudi Arabia, yes, it will make you rich, but it's not going to work for most oil fields anymore because prices will be lower and risk will be considerably higher. And therefore, you can still do new projects, but you've just got to do them within the context of a very different planning and thinking environment.
Thank you. And building on that, can you reflect, can you tell us what was the most interesting trend that you have seen in 2020?
It's hard to look past the coronavirus crisis, of course, which has rattled energy markets. It's the biggest shock to energy markets since the Second World War. But looking past that, I think what really struck me is the fact that at least part of the oil industry, companies like BP, Shell, and others are clearly attempting to make a shift. If you look at the plans, BP wants to sell 40% less oil and gas in 2030 compared to today. Shell has the ambition to become the world's biggest electricity company in 15 years. Of course, it remains to be seen to which extent they can really deliver on those goals and implement them. But I think it's definitely a sign of the times that these companies are making the shift. And importantly, I don't think they're doing this for moral reasons because they think that we should stick to the Paris 2 degrees or 1.5 degrees goals. But it's because they are feeling the heat, they're feeling the pressure from shareholders and from society as a whole. So I think there's clearly a change in the oil industry's social license to operate. And for me, that stands out as a significant shift.
Thank you. And let me go back to Erica. This reflected on COVID and this 2020 year, which has brought us a lot of surprises. Can you tell us what you're seeing in the recovery and stimulus measures, and which way are they taking us?
Yeah, I think that's a very good question. What will happen to the stimulus packages? Will they be green or black? In our estimate, it depends on the region. What we see in Europe is sort of an outlier. There, a lot of effort is going to this Green Deal. In the world, that is not equally the case. So for the world at large, we see these green forces and the black forces sort of both coexisting. And they sort of even each other out. So the net effect on the transition speed is actually neutral. This is how we see it, but as I mentioned, it looks different in Europe. And I think the Norwegian case, I find myself in Oslo, the Norwegian case is interesting. So on this graph of TES, he showed Norway to the left. Of course, we are heavily oil dependent. The economy is 20% oil and gas based. And so when you see these stimulus packages, there's a lot of political discussions, where should they go? But a lot of it actually goes to the oil and gas industry, because that is where the current jobs are. And if you want to move them to green sectors, there is not the industry, there is not the oil services industry in the green field. And I think globally that is partly the case. There is currently, the incumbent is a bigger sector in the economy. And I think that provides for this very mixed picture. So the end result is, as I mentioned, there will be a neutral effect from these stimulus packages in terms of speed of energy transition.
Thank you. And Kingsmill, can I go back to you with a couple of audience questions as well? How do you define the stranded assets? And can you also reflect a little bit on the shale, because nobody really touched upon that, the future of shale companies?
So CarbonTracker has on its website, the CarbonTracker.org, a formal definition of stranded assets. But since you put me on the spot, stranded assets is basically something for which there is no longer any use. So if, for example, you today build an Arctic oil well with the expectation of you'll need $100 oil for that to be profitable, and the price never gets back to that level, that's immediately, and you close it down, that's a stranded asset. But actually it's slightly wider than that. It's assets on which you will not get the return that you anticipate when you build them. So for example, if you're building a new petrochemical plant today, in the expectation of ever rising demand for plastics, and continued high price of plastics, and actually you get perennial overcapacity and lower prices, then that too becomes a stranded asset from the perspective of the financial investor. So it's a moderately wide way of defining stranded assets. But the future for shale, again, it depends on price, right? I mean, if Ben Eric is right, and oil demand's going to peak and start declining, and then Tess is also right, and the very low cost producers in OPEC decide to start to sell the oil while they still can. I mean, why on earth would you need any high cost oil? So any high cost oil, be it shale or Canadian oil sands or whatever it is going to obviously have to close down, and there's just no point doing it anymore. It's just a waste of capital, waste of resources, waste of time.
Thank you. And Tess, just a pick up on your point on the oil economies. Do you see that plastic could be a savior for oil economies?
Well, I think if I look at, for instance, the latest World Energy Outlook of the International Energy Agency, I believe that the growth in oil demand that they see happening over the next 10 years is driven almost, I think, for 60% by increased demand for plastics worldwide. So it's sort of the last vestige where oil demand might still grow over the next couple of years, or it might not, as I mean, others have not forecasted such growth. But the trouble is there that Kingsmill has also done some analysis on this. We see worldwide that there is increased action by governments, but also by non-state actors on curbing single-use plastics. European Union this summer agreed to a very big recovery package, which imposed an €800 tax per ton of plastics. So there is a plastic tax now in the EU, which might further curb demand. You see that China has limited imports of single-use plastics. So I think it's a bit risky to bet on petchem and plastics industry as sort of the savior of the oil industry. Even if it is the savior, it's only going to prop up oil demand for, I mean, only a couple of years, and it's also feeding a very unsustainable industry. Of course, we know that each year 8 billion tons of plastics ends up in the ocean. So that's really another environmental issue besides climate change that we of course have to address.
Thank you. We have 5 minutes to finish, and I would really like to take another round of questions from the audience. So let me quickly go to Ben Eric. Hydrogen. What is your picture on hydrogen?
So hydrogen, we have changed our view over the last 4 years. We were skeptical 4 years ago, but what we've seen over the last 2 or 3 years is that there is more focus on really a zero emission economy, so in Europe in particular. And so we see uptake in a couple of sectors. We do see that there will be a use, for instance, in UK, in buildings for hydrogen, where you use the existing natural gas infrastructure and you pour hydrogen instead through that piping system. We also see that there will be increasing use of hydrogen in industry for high heat processes, because in many instances, this is the only low carbon solution. And finally, in transport, we see hydrogen and ammonia in shipping and in long haul trucks. We do not see hydrogen in passenger transport because it is too expensive, and also the energy equation is much worse than for battery electric propulsion. And for 99% of the use in passenger vehicles, you know, the ranges we talk about now, around 500 to 600-700 kilometers in only a few years, that will suffice. But that will not suffice for long haul trucking. So we see that there's a fraction of trucking, the long haul ones, that will use hydrogen in the future. But we do not see more than, I don't remember now, but I think it's about 8% of the global energy demand will be supplied by hydrogen in 2050. So we do not see a hydrogen economy, at least within the next 30 years.
Thank you very much. Kingsmill, very quickly, what is your advice to fossil fuel companies, which still have a big responsibility to fulfill in the transitional period, but knowing that long term they will have to change their business model?
Well, I think the message has got to be change or die. You know, do you want to end up like the retail sector, which failed to have an internet strategy, or the telecom sector, which failed to have a mobile strategy? And you have to have a strategy for this new world which is emerging in order to survive. And because these companies are giant and hugely dependent upon business as usual and continuation, you need the kind of aggressive, rapid turnaround that we've seen take place in Ørsted and that Bernard Looney is seeking to push in BP in order to do it in time.
Thank you very much. And this very quickly on the geopolitics, what about rare earth? Is there enough?
Yeah, well, as I said in my presentation, there's this natural tendency of people to stick to familiar terms and concepts, and they just transpose their thinking of oil and gas onto the markets for minerals and metals. They see that you can also talk about minerals and metals in terms of resources and reserves, just like oil and gas, that some of them are geographically concentrated, etc. But that does not mean that they are the same. I mean, if you look at minerals and metals, they're not like oil and gas markets. They are much smaller, much less liquids, and there are more opportunities for innovation. For example, in the chemistry of batteries, where you can engineer out cobalt so that you do not use it anymore. So you can switch from one set of elements to another. And there are also far more opportunities to reduce, reuse, and recycle some of these materials. So in short, the answer is yes, there's enough. And even if there's not enough, or if there's market concentration, you can see that we might go through some cycles where lacked investment creates maybe some kind of scarcity in the short term, but in the long run, there's surely enough, especially also if you implement some of the principles of the circular economy.
Thank you very much. We have 1 minute left. So very quick, what is the one question that you would not want to be asked ever again? Kingsmill.
It's probably the question about the emerging markets. People always go, well, look at all these poor people in India and China and Africa and Southeast Asia. They don't have enough energy. They need more energy. It must be fossil fuels. And of course, they do all need more energy. They're not getting it from fossil fuels, and they're going to get it from the cheapest, cleanest local source, and that's now renewables. And that's the answer. Thank you.
Please.
Well, I think we should stop discussing or asking the question, when is the date of peak oil? It's not really relevant. You have to look at deeper structural trends which are ongoing, which, by the way, also predate the pandemic by many years. And it's not like we will wake up in a different world the day after the peak. So that also means that the effects of slowdown in oil demand growth are already being felt now. And that overall, I think the significance of peak oil is that it signals a shift in a paradigm from an age of scarcity to an age of abundance, which is likely to also go hand in hand with a shift to a more competitive market environment.
And Eric.
Yeah, so the question I don't like to get asked is, how can you, as a small research group with about 5-6 people, be so certain that you understand the future when you have in Paris, you have IEA with, hundreds of people who look into the same. But then I answer, you have to do it smarter. And what we've seen over the last couple of years is exactly that consensus is moving our way. In general terms, our forecast has not changed that much. It's basically the same, and others are every year moving towards us. So we feel very confident that we are on the right track.
I thank you very much for your optimistic messages at the end. The one question that I would not want to be asked ever again is what happens when the sun doesn't shine and wind is not there, because we know that technology solutions exist. We know that markets are shifting the way of renewables. We know that energy mix will be different in the future, will be flexible, will be democratic, will be available to all. And on that optimistic note, I want to thank all our audience members who have been super active, and to apologize for the questions we couldn't take. Perhaps we need another one of those. Thank you very much.
Thank you very much.